Good morning, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We're pleased today to welcome John Miller, Managing Director, Global U.S. Portfolio Management for Canada at Epoch Investment Partners, here to talk to us about the TD Asset Management Global Equity Dividend Strategy and their market outlook. Please note that if there's enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ insurance representative for all other questions. So without further ado, John, the floor is yours.
Thank you very much, Matthew, and thank you for all those who are dialing in through the webinar. Today, what I hope to accomplish today is give you a little bit of background on how we think about the markets on a go-forward basis, how we're currently positioned within the portfolio itself with the SSQ TD Global Dividend Fund, and then also walk through a little bit further detail about our investment process. So turning to page number 1, a little bit of background on Epoch Investment Partners. We're the sub-advisor of the investment solution. And on page number 1, we walk through a little bit of background on our firm. We were founded in 2004, so we go back just a little over 15 years since the company was founded by a very experienced team of investment managers. Many of them have worked together in the past. The firm was acquired by TD Bank in 2013, just coming up to 6 years at the end of this March. And we're headquartered in New York City. We have approximately 120 employees and currently managing just a little over $48 billion in assets, founded on this investment philosophy that's really driven by this idea of identifying companies that have a growing level of free cash flow, and I'll define that in a couple of moments. And then this construction process with respect to each portfolio where it's embedded, the risk management process is embedded in the process. And I'll walk through what I think are some of the positive benefits associated with that. On our website, we have over 90 white papers that are available at www.eipny.com. Go through a variety of different topics that might be of interest to you at some point in time. Moving over to page number 2, a little further background on the firm. On the next page, goes through, you can see on the map where our assets are spread from a client perspective. So we have approximately $18 billion in Canada. We have over $25 billion of clients where we manage their money in the United States. And then you can see throughout Europe and in Australia and Asia, we have a further $2.6 billion. The largest strategy by far is the strategy that you're invested in at SSQ in this global dividend mandate, and it represents approximately 40% of our assets under management, this idea of income, dividend, a collection of businesses that have a growing stream of dividends, and it's I would argue it's the most important part of our franchise with respect to this strategy. Our investment philosophy is centered around finding companies that generate free cash flow. I mentioned that earlier. And what I want to do now on the next page is just walk through what do we mean by this definition of free cash flow. And so there's only 5 things that a company can do, a management team, in fact, when a business generates free cash flow. And those 5 things are they can acquire another business, acquisitions. They can reinvest back in their business in terms of capital expenditures, plant, equipment, typically ways to improve productivity. So those 2 are what I would define as really reinvesting for growth. Or you can return the capital to you and I as a shareholder, what we call shareholder yield, through either cash dividends, share buybacks, or paying down debt. In the last 3, cash dividends, share buybacks, and debt reduction, we see as really returning capital to you and I as a shareholder. Your strategy, the SSQ Global Dividend Fund, is really focused on a greater emphasis is put on cash dividends, share buybacks, and debt reduction. And as such, we call it a shareholder yield-oriented strategy. On the next page, goes through a little bit of detail on where this strategy might be appropriate or investors that might be attracted to this type of strategy. And I would call it it's a very diversified portfolio. We have approximately 102 companies in the portfolio. So it's very diversified not only by sector, by geographic region, by the exposure, by the cash flow growth rates. But there's a couple of key variables that I would say are the similarities in the strategy, and that is a relatively high dividend yield from the portfolio. So dividends, share buybacks, and debt reduction being three very important variables. And then we look for companies that have a growing stream of cash flow. So it's not just a high dividend yield, it's companies that also have a growing stream of cash flow, so that it's also protecting that franchise on a go-forward basis. The way we design the portfolio is we're trying to seek this, I call it 8 to 9% average total return over a full market cycle. And we've delivered that, in fact, over the last 13 or so years, that since the fund was set up in December of 2005. The long-term track record is between 8 and 9%. Excuse me. And then who would this be appropriate for? It'd be appropriate for those clients who are looking for a consistent, stable dividend income yield. We think dividends provide a stability factor in a portfolio because they almost act as a buffer on the downside, and we're quite proud of our downside protection. I'll walk you through a couple of proof points associated with that in a few moments. And then it's a very diversified core holding, so it really fits for those clients who are looking for lower than market volatility, so less volatility than a typical portfolio. And as such, it has a relatively low beta, or sort of a smoother path of returns in that downside protection that I mentioned a few moments ago. Moving to the next page, I'll just give you a couple of proof points on the S&P 500, and this goes back with 90 years of history on page 5. It shows you that the history of the S&P 500 from 1927 through to 2017, that long-term history, the 90-year history, has delivered about 10% total return. And then when you break those returns down, what percentage of the return came from dividends? What percentage of that 10% came from earnings? And what percentage came from either PE expansion or PE contraction? And of the 10% total return, roughly half of it, 5.2%, came from earnings growth. That shouldn't be a surprise. This is really, it tracks GDP growth. It's really the earnings from all the companies that are in the respective, that make up that S&P 500 index, and it's about 5%. An additional 3.9% of that total return came from dividends. Dividends, that darker green line, it's in fact the smoothest line on that table. And it's one of the reasons that we focus on the emphasis or the importance of finding businesses that have a higher than average dividend yield, and they're paying it back to you and I by way of the shareholder yield strategy, by way of either cash dividends, buying back their own shares, or paying down debt, which effectively shifts ownership from the debt holders to the equity holders. On a go-forward basis, we're trying to capture these two, both the earnings from the businesses and the dividend yield. Next page just gives you a couple more proof points. On page number 6, you can see that those companies that have either growing dividends or stable dividends have provided a higher than average return over the last 24 years. And then secondly, which most clients are looking for, they not only want the higher rate of returns, they also want less volatility, a lower standard deviation. And in fact, stable dividends or growing dividends have around 3/4 of the volatility of a company that has no dividends or in fact has cut their dividends. And so that's why we focus so much on stable to growing dividends for companies that are in the SSQ Global Dividend Strategy. On the next page, just gives you a little bit of history about those companies within the portfolio. And keep in mind that we have approximately 100 businesses in the portfolio. So you can see anywhere from sort of 62%, 70%, 83%, 79%, 84%, approximately 60 to 80% of the companies in the portfolio have increased their dividends. And in fact, they've increased the dividends at a rate that's much higher than the average rate of inflation. If you think of inflation running at around 2 to maybe 2.2%, the average dividend increase has been more like 5 to 6 to 7% on an annual basis. So it's a nice hedge against inflation, and it also helps to capture productivity improvement from those businesses that you own within the portfolio. On the next page, it gives you some history of our actual mandate. On page 8, you can see it highlights those 3 areas I mentioned: cash dividends, share buybacks and debt reduction, and cash flow growth. So this is really the template for what are we looking for to get at this 8 to 9% targeted return over a full market cycle. And in the upper right-hand side of that page, it shows you our history going back over the last 13 years. It's delivered around 8.4%. So it's nicely beat the index, which is around 6.6%, and it's done that with less volatility as exemplified in the standard deviation. You can see it's around 80% of the standard deviation relative to the index. On the next page, just a little further breakdown in terms of how do we construct the portfolio, what do we screen for, and it's really a blend between using, I'll call it, quantitative screening techniques, and then we use that to narrow down the investment universe from approximately 12 to 14,000 companies globally. And then we screen for things like high dividend yield, high free cash flow, strong balance sheet, leadership position in their particular industry, usually first, second, or third in the industry they're competing in. And we then start the fundamental analysis that each week when we run the screen, usually 5 to 10 new names pop up. And then we allocate those to the portfolio managers and the investment analysts that look through name by name, industry by industry to identify those businesses that would be appropriate to go into the portfolio. What you end up with is around 100 securities, and so we think it's one of the best ways to build a diversified portfolio, a collection of those businesses that have those attributes that you're typically looking for in terms of cash dividends, earnings growth, and protecting that business by way of reinvesting back to protect their franchise on a go-forward basis. How to bring this to life with maybe a couple of examples. On the next page 10, we walk through 10 and 11 are 2 company examples that are in the portfolio. And the first one I'll talk about on page 10 is Las Vegas Sands Corporation. For those that have visited Las Vegas, you're probably familiar with this particular company. They have ownership operation. They're the largest developer, owner, and operator of integrated casino resorts. They have operations in the United States, in Singapore, in Macau. They generate just a little over $13 billion in revenue, and they do that by paying, they do that in addition to actually paying back to you and I a fairly healthy cash dividend that's in excess of 5%. It ended December 31st at around 5.9%. That's the dividend yield. So it's a very attractive dividend yield. I would qualify this company as being slow, stable, consistent, predictable. You're not going to get 20% like returns out of a business like this, but just steady, consistent business involved in from the casino, involved in the hotel management, mall, food, beverage, convention, operations, all the typical revenue streams that you might suspect would come from an operation like this. And they're globally diversified, as I mentioned earlier. On the next page, just another example of the kind of holding that would show up in the portfolio. And this is from the utility sector. And for those that, of course, pay a utility bill on a monthly basis or bi-monthly basis, you know that it's steady, stable, consistent revenue that's generated by a utility. Again, you never get very high growth rates with a business, but it's very steady, stable income. And as such, companies like American Electric Power, they're a regulated utility, so they actually build into their pricing power or pricing structure, if it's approved by the board, anytime they expend or invest additional funds back into the business to build or upgrade their transmission lines, that actually goes into the rate base and is passed through to you and I paying our monthly bills. It generates a dividend yield of around 3.8%. And again, it's a profile of a business that just nice, steady, stable, consistent growth that fits in that theme of slow and steady wins the race. On the next page, just a little more detail about the sectors where we have exposure. And you can see on page 12 the sectors, and I'll highlight the top 5: financials, utilities, consumer staples, communication services, and healthcare. And we've typically had a fairly healthy weighting in really all 5 of those sectors. Where we have a lighter weighting Areas like information technology, and it's nothing against information technology, but many businesses within that sector do not pay a dividend, or they do not pay a high enough dividend that they would pass the screen to be in the portfolio. And then materials is a relatively low weighting in the portfolio as well. They tend to be more volatile cash flow streams, and as such don't qualify to go into the portfolio. So as such, you end up with, you can see in the far right side, we ended the quarter with a little over 100 securities in the portfolio, an average market cap of 121 billion. So you can see that it's, I would call it, relatively large cap with respect to the exposure of the businesses in the portfolio. Just to put it in perspective, 121 billion would be about the size of market cap of TD Bank. Royal Bank would be just slightly higher than that, but it gives you an idea of the average market cap of companies in the portfolio. In terms of country weightings, you can see through the middle bars, they're all really fully developed countries, so we have very little, I'll call it first or direct exposure to any of the emerging markets: USA, the United Kingdom, Germany, France, Canada, Italy, Switzerland, Australia, Spain, Singapore, Norway, Sweden, Taiwan round out the top 10. And then some smaller weightings sprinkled that show up in the other for the 2.1%, just to round out the portfolio. But as I mentioned, we tend to focus on those more fully developed countries that have global exposure, but we're doing it through accounting and records that we feel a little more comfortable with. So it tends to be more focused on those countries that would be described as really developed. On the next page, just to highlight the top 10 holdings in the portfolio. On page 13, we go through, you can see the fund weight. So very diversified. No one company is greater than 2%. You can see that the top 10 holdings would represent less than 20% of the portfolio. The dividend yield in the middle column, and we do not rank these securities by the higher dividend yield, would move it to the top. It tends to be a nice balance between dividend yield, growth in the cash flow stream, reinvesting back in their business. And so it's really a blend of all of those factors of giving back cash to you and I as a shareholder and reinvesting for growth to protect the franchise. In terms of the countries and sectors, I've mentioned them already, but you can see we tend to have a heavier weighting in those sectors that would be more known to be more consistent. So it tends to be more consumer staples, communication services, financials, and healthcare or real estate investment trust. If you look at a name like Welltower, it's a healthcare real estate investment trust. For any of the people calling in today or listening to the webinar, if you've ever had a parent or grandparent go into a senior's home, many of them with medical facilities attached to it, they tend to be running at pretty well full occupancy, and they pay back out a fairly healthy dividend, around a 5% dividend yield from a company like Welltower, just to give you a quick example. On the next page, I mentioned this at the outset of one of the features that we are most proud of, and that is our downside protection. So in the event that the market goes through additional volatility, and we do expect increased volatility, not just like we saw in the last quarter of 2018, but with a number of the headline issues that I'll talk about in a moment. And what we did is ran the numbers for on a quarterly basis, and we just kept rolling those quarters forward. And we looked at any period of time, any quarter where the market was negative, so even just a little bit below zero in that 3-month time frame. And we measured in 79% of the time where the quarter was even just a little bit negative, we actually outperformed, and we outperformed by a margin of 3.48%. And then even more dramatic, when the market was down greater than 5%, and that was in 19 of the 154 quarters. So around 15% of the time, we had that kind of an environment. And where the market dropped greater than 5%, we actually outperformed 100% of the time, and we outperformed by a margin of 4.73%, as you can see on that slide. So that's what I mean by we're quite proud of that downside protection. You hate to wish for a market to prove your point like we had in the fourth quarter 2018, but it does give you the idea of the construction of a high-quality portfolio with dividends that act as a bit of a buffer in a market environment like that. There tends to be a shift to more quality, as you might suspect. On page number 15, I just wanted to provide a little bit of an outlook with regards to where do we see the market going in 2019 and what are some of the issues that we're watching for. I will say in the United States, it's still running at very strong GDP. We do think it's going to slow in 2019 a little bit, and some of the impact will obviously be from the government shutdown that took place for a greater period of time than 30 days. And that will have a negative impact on the first quarter growth rate for all those people that, of course, would have cut back on consumption and spending. And keep in mind that the U.S. is driven by, the GDP, in the U.S. is driven by consumption, is about 66% of total GDP is driven by the strength of the consumer. So there will be some moderating impact from that in the United States. We expect that to show up in the March Q1 2019 numbers. In Europe, still a little bit of impact, of course, coming from Brexit and their negotiation with respect to their divorce from the European Union. That's yet to fully play out, but it is causing some other issues throughout Europe, and I think you're seeing growth rates slightly lower throughout the European region, slightly slower than where the U.S. growth rates are. Some challenges taking place in Italy with their budget as well, and you've seen, if you've watched the news, just looking at some of the, I'll call it, issues that are taking place in France. So a few things that are taking place around the globe. We do think that there will be an orderly negotiated deal for Brexit that will take place. It may not happen on the magic date of March 30th. It might take place over a slightly longer period of time, but eventually they will come up with an agreement that's satisfactory to both sides. Emerging markets, a little more challenging. As you might suspect, many of these emerging markets that have currency devaluation issues where they have their debt denominated in US dollars and they're actually paying it with their currency that's actually gotten weaker over the last 12 months plus, that can cause some challenges. And so as such, I would say we've avoided the emerging market sector. Many of the businesses that are global in nature would still have exposure there, but in terms of direct exposure, it's one of the reasons why we have very little direct exposure to the emerging markets. Equity multiples, in our opinion, are unlikely to increase. And the reason we say that is as these interest rates around the globe start to gently rise, and we don't expect a rapid rise, but gently rise from all of the central banks being in what we call quantitative easing, so a more accommodative setback, shifting to this quantitative tightening where the central banks are taking away some liquidity from the marketplace, and with that, rates will naturally start to rise. Again, we don't think at a rapid rate. This return of price discovery, I'm sure you're well aware of the shift that's taken place from not only active management to passive management, and where there's very little price discovery in any of these ETFs. I think you typically find in a market that tends to have more volatilities, you do see a return to price discovery where people want to look at, what do I own? What's in the portfolio? Do I feel comfortable with it? And anytime you get an increase in volatility, as we've seen throughout the fourth quarter of 2018 and then parts of 2019, we do think that you'll see this, I'll call it, shift to quality that's taking place in the marketplace. So we do expect rates to gently move higher, and we do expect volatility to tend to be higher than what many people have been used to over the last 7 or 8 years, where it was in the low teens, bumping up to more its long-term average of more like 17%. And then technology, we're all familiar with the positive impact of technology helping to drive productivity growth. It's helping to improve profit margins in many businesses. It's helping to improve the asset utilization or asset turns within a business. You can actually have fewer assets for the same level of sales to drive that productivity improvement. And then with that, businesses can actually use more leverage or have less equity in their business itself, just measured by debt to equity, and as such, we think they can increase their payout ratio to you and I as a shareholder by way of either increasing dividends, buying back their own shares, or in fact paying down debt if that's the focus of the business. And the last point, which is not to be understated, but this risk of a trade war or trade tensions around the globe, probably exemplified by Trump's approach, and maybe I should say unusual approach to how he negotiates with most of these other countries around the globe. But China is a very important player, given that the United States is roughly about a $20 trillion economy, and China is the second largest economy at around $11 to $11.5 trillion. And so these two, number one and two, world economic powerhouses are currently in the middle of negotiations, and depending on how that plays out, you've seen it, of course, in the headlines with respect to some of the negotiations with respect to the extradition issues that are taking place with Huawei and having that individual sent to the United States for, again, additional. It just creates headline risk around that, where I think you can see it show up in the volatility numbers, and we think this may play out over a couple of years, in fact. So given all of the above issues in the marketplace, we think that it's, as the bold box at the bottom of that page highlights, that given these issues, it's even more important to favor companies with a demonstrated ability to produce free cash flow and allocate that cash flow wisely. So it's really a shift to, again, a more defensive nature, a more defensive stature, looking at quality. It's not the time to stretch in terms of looking at lower quality or more speculative. It's in fact the time to focus on high quality, high cash flow, and the strength of the businesses that are in your portfolio, in our humble opinion. So with that, Matthew, happy to turn it over to the group if we have time for any questions. We did include in the appendix, and I'm sure is available on the SSQ website, a couple other additional pages that are in our appendix, but I think just in terms of time to leave enough room for questions, should there be anything that comes from the group or from the head office, I'm happy to answer that, Matthew. Turning it back to you.
All right, great. Thank you, John. So, like John mentioned, we'll now proceed to the Q&A part of the webinar. So if you have any questions, like I mentioned earlier, just use the WebEx interface, and I'll be able to ask John. The only question we received so far, someone wants to know how you performed in the last weeks following the correction that we had in December.
Yeah, in the fourth quarter, well, obviously October was a rough month as well, and then November things sort of settled down a little bit, and then of course back full force in the month of December. It was the worst December in history, in fact. And just to put it in perspective, the last 3 months of the year, the index was down around 8.5% in Canadian dollar terms, and we were still down, but only 2.7%. So we outperformed by 5.8% over that 3-month period of time. So not that I want to say 3 months makes a trend, but it's probably a good test for what happens in the event of either increased volatility or further tensions on all those issues I highlighted on slide number 15. So that gives you an example, Matt, of the downturn and our outperformance during that period of time where the market was down greater than 5%.
Okay, good. And we have another question. Someone who wants to know what is the yield from January onward?
Yeah, so the way we calculate that yield in the portfolio, it's the gross dividend yield at the end of December 31st, 2018. And at that point in time, so it looks at the prior 4 quarters, so the prior 12 months, and the yield, it ended that time period at around 4.6% was the dividend yield at the end of, and that's the gross dividend yield. And so I sort of underline that term gross because the average investor would not receive the full dividend impact because of there's things like taxes or withholding taxes that take place depending on where the dividends come from and what the tax treaty is with respect to Canada to that respective country. And then you also have fees, of course, that would also be offset against that dividend yield before it's paid out to investors.
Okay, great. So that doesn't seem to have any more questions. So thank you, John. It was very interesting. So with that, it'll conclude the presentation. So to all of you who have listened to the webinar, thank you for your participation. And come back in February as a Jaroslawski Fraser team will discuss their Canadian equity funds performance and positioning. So thank you for everybody. Have a good day.
Great. Thanks, Matthew. Bye-bye.